Welcome back. In our previous sessions, we introduced the broad language of SaaS metrics. Today, we are going to master the single most important growth parameter for any subscription business, monthly recurring revenue, or MRR. MRR is the root of everything in SaaS. It is the foundation for calculating your customer lifetime value, understanding your sales movements, and getting your retention and churn values right. But more than just a dashboard number, MRR is the bridge between your operational growth and your formal financial records. In this module, we will move past surface-level definitions. We'll dive deep into how MRR is booked and calculated, how to build a high-resolution MRR sheet, and, crucially, how the world of metrics converges with the world of bookkeeping through recognized revenue. Chapter 1. The Deep Dive. Why is MRR so critical? For stakeholders, it is the clearest indicator of how revenue is actually generated, whether through new sales, upselling existing customers, or recovering churned ones. It provides a predictable view of the future. For investors, MRR is the primary driver for valuation. In the SaaS world, companies are typically valued as a multiple of their annual recurring revenue, or ARR, which is simply your MRR multiplied by 12. If your MRR calculation is flawed, your entire valuation is built on a shaky foundation. But the real value of MRR isn't just the final number, it's the mutual language it creates between the CEO, the board, and the finance team. To speak that language accurately, we must ensure that the growth we see on the sales dashboard matches the revenue we see in the books. Before we get into the bookkeeping, we must define what actually counts as MRR. Accuracy is everything. MRR must only include the predictable revenue you expect to receive every month from active subscriptions. This means you must be disciplined. You should include recurring business and subtract any discounts so your MRR reflects the actual amount billed. However, you must exclude one-time fees, such as professional services, setup fees, or hardware sales. These are one-offs that artificially inflate your growth and provide a false sense of scale. By separating these non-recurring items now, we set the stage for correct revenue recognition and financial reporting. There is a common misunderstanding that MRR is just a metric and revenue is something different for the accountant. In a high-performing SaaS business, these must be the same. This alignment happens through recognized revenue. In SaaS accounting, we use the principle of accrual accounting. Unlike traditional businesses, we provide a service over time. Take a look at this example. When a customer is invoiced for $1,200 for an annual plan, you haven't earned that money yet. It enters the books as deferred revenue, a liability on the balance sheet because you still owe the customer 12 months of service. Each month, you recognize 1/12 of that payment, $100. That monthly recognition on your P&L is the accounting equivalent of your MRR. If these numbers don't match, your metrics and your books are out of sync. To properly book your MRR, you must ensure that the revenue streams from various services can be split and detailed. To get this alignment right, accounting must follow a strict framework under international accounting standards. To properly book your MRR, you must follow these 5 steps. First, identify the contract. This is usually your digital terms of service. Second, identify performance obligations. What are you actually providing? Is it software license, and does it include premium support or onboarding? And very important, over which period are you obligated to deliver the service? Third, determine the transaction price. This is the total amount the customer will pay after discounts. Fourth, allocate the price. Finally, recognize revenue as the service is delivered, meaning month by month. Practically, in your bookkeeping, you should invoice and book these items individually using separate product numbers or items. For example, use one product item for SaaS licenses and another for consulting fees. Thereafter, ensure that your invoices are booked with accruals. This division and accruing the invoice makes it easy to extract the data you need for your MRR sheet later. This granular setup is what ensures your metrics are always audit-ready and easy to use. Now for Chapter 2, the MRR Sheet. To manage this at scale, you need an MRR sheet. This is not just a summary, it is a total overview of every customer and every recurring product they buy, split out by month. The real value of a granular MRR sheet is the ability to see fluctuations at the product and customer level. Strong companies don't just look at their total MRR, they dive into the details to see exactly which features are driving upgrades and which customer segments are contracting. In your MRR sheet, every customer should have their own row, and every product or license type should be tracked. This allows you to identify hidden churn, where a customer hasn't left yet, but they are buying less than before, which we call contraction. Without this level of detail, you are flying blind. With it, you have a strategic command center for your entire business. If your accounting is done properly as described, you will be able to produce the MRR sheet from your bookkeeping by extracting all your account or invoice lines. Being able to produce the MRR sheet directly from your accounting is the key to generating detailed MRR movements, like upsells and downsells, at the customer and product level. This turns your bookkeeping into a high-resolution command center for your business. Now for third chapter, the MRR Bridge. Now, we have all the fundamentals for building bridges. An MRR bridge is a visual tool that shows the movements on your revenue from the start of a period to the end, and preferably over a longer period. Strong companies use their MRR sheet to populate this bridge with incredible detail. There are 5 movements you must track. New MRR, which is revenue from brand new customers. Expansion, MRR. Additional revenue from existing customers who upgraded or added seats. Reactivation, MRR. Former customers who return to a paid plan. Contraction, MRR. Revenue lost when customers downgrade but don't cancel. Churn, MRR. Revenue lost from customers who cancelled entirely. And then this leads to your net new MRR, which is new plus expansion plus reactivation minus contraction plus churn. An MRR bridge can be visualized as shown here and is the most effective way to visualize revenue growth because it decomposes a single final number into its moving parts, telling the story of how you got there. Rather than just seeing a total, it separates momentum into building blocks and leaks. The key elements to watch are 1. The baseline, your starting revenue at the beginning of the period. 2. Growth drivers. New sales, meaning acquisition and upsells, which is an expansion of current accounts. 3. Revenue erosions, downsells, which are customers spending less, and churn, which is customers are leaving entirely. And 4. The finish line, your ending revenue after all gains and losses are accounted for. From this model, you can extract your growth quality, your retention health, and last but not least, your net revenue retention. So ask yourself, is your growth coming from brand new customers or from successfully growing your existing ones? Does your churn or downsale erode the picture? And if your existing customer base is growing or shrinking on its own, which is the ultimate indicator of product market fit and long-term sustainability? And that is exactly why getting your bookkeeping right from the start is so important. The key takeaway is this: if your accounting is done properly, with revenue streams split by product and account numbers as we described, you can produce your MRR sheet directly from your bookkeeping. Being able to extract these invoice lines from your ledger is the only way to produce these detailed MRR movements with total accuracy. Let's look at Chapter 4 for the specific KPIs that either define MRR or use it as their primary fuel. When your bookkeeping is granular and your MRR sheet is accurate, you can unlock these high-level insights. 1. Net new MRR is the ultimate growth indicator, showing your real progress after accounting for all gains and losses. The formula is new plus expansion plus reactivation minus contraction and churn. ARR, or annual recurring revenue, is your MRR projected over a year, used for high-level goal setting and company valuation. ARR equals MRR, multiplied by 12. ARPU, or average revenue per user, is the average amount a single customer brings in each month. Increasing this is often a more efficient growth strategy than finding brand new customers. On retention and churn, revenue churn rate is the percentage of recurring revenue lost from cancellations. Net revenue retention, often called the king of metrics, measures how revenue from existing customers develops over time. A high NRR above 100% means you can grow even without acquiring a single new customer. Contraction MRR is your early warning signal for customers who are buying less, even if they haven't left yet. Finally, by combining MRR with acquisition costs, you can see if your growth is actually profitable. Customer lifetime value, or CLTV, is an estimate of the total revenue a company expects to earn from an average customer throughout the entire relationship. It is calculated by dividing average monthly revenue per customer by your monthly churn rate. The CLTV to CAC ratio compares the value of a customer to the cost of acquiring them. For a sustainable SaaS business, CLTV should be at least 3 times higher than CAC. Remember, MRR is your navigation system. When it is aligned with your recognized revenue, it becomes a fact-based tool for decision-making. Use your MRR sheet to go deep into the details of your customers and products. Only then can you truly understand the drivers of your growth. That brings us to the end of this module. We've gone from the basics of MRR all the way through revenue recognition, the MRR sheet, the bridge, and the key KPIs that drive real decisions. Thank you for joining me today. I hope this gave you a clearer picture of how MRR works, and I'll see you in the next one.